The purpose of this meeting is to engage in a comprehensive discussion about the time series section, which is a part of the Finance Research Gate website. First, you'll need to make a selection regarding the specific frequency setting that you'll be working with for this task. For now, I'll begin by selecting the annual frequency option, and following that, I will proceed to choose both the starting and ending years, and that's a step I've already completed. Moving forward, my primary objective now is to meticulously construct and generate the various data series that we'll be utilizing. It's crucial for everyone to understand that this particular analytical section of our work commences directly with the comprehensive panel dataset. This means that when all is said and done, we possess a very substantial and robust collection of 150,000 individual observations. From there, we need to build the time series variable. For example, if I start series A and then I select first, we consider the stock return, specifically focusing on the annual return. Our next step is to aggregate this crucial variable across all of the firms that are present in each year. Therefore, when we are ultimately dealing with a time series variable, it is essential that we have precisely one distinct data point corresponding to each specific period. And for this, we need to perform an aggregation process that spans across all the different firms. Now, if we choose to leave these particular filters completely empty, it implies that our analysis will encompass every single firm present within the entire dataset. Alternatively, we have the option to precisely specify and limit our selection to a certain number of specific tickers, particular sectors, and other relevant categories. If we leave these parameters unspecified, then by default, our analysis will encompass every single firm. This provides a comprehensive description of all the firms upon which we have performed the aggregation process. And then you can name the output series. For example, we can say it's just simply the annual return. Once we've finished up with this, we'll then be able to create a whole range of additional series just by activating the Series B feature. And then from there, we'll proceed to create an additional variable for our analysis. As an illustrative example, I have the option to select a variable, such as the company's overall size, specifically its current market capitalization or value. Initially, I intend to include every single firm in the dataset as the default setting, but then I will proceed to carefully apply specific filters right here to refine our selection. And then as a crucial step, I proceed to assign a clear and meaningful name to the generated output series. For example, a very typical designation I might choose would be firm size. This means I have the flexibility to create as many series as I desire. Further down, you'll see the comprehensive descriptive statistics. And the specific section or the box that we will be concentrating our attention on today is the one dedicated to transformations. Therefore, if you look directly above the main chart, you'll notice a feature prominently labeled as Derive New Series. Now, at this point, we have the ability to transform and generate a completely new series by utilizing a wide array of different functions. Among these, the primary category is algebraic, which encompasses numerous specific functions, such as the logarithmic transformation. Therefore, you would systematically apply the logarithm to every individual value within your existing time series, thereby generating a completely new one. To consider a practical illustration of this principle, we can begin by establishing a specific metric, which we will refer to as log return. Following this initial step, once we have successfully generated or computed this particular value, it then becomes possible for us to assign it to a completely new and distinct variable, which will also be designated by the name log return for clarity. It's not advisable to use the logarithm on negative value series. For example, with annual returns, in certain years, you might encounter negative values. If you then attempt to apply the logarithm, that would result in a missing value because we simply cannot compute the logarithm of a negative number. Similarly, you can utilize the square root. And the core idea here is to take those large values and convert them into a more manageable, reasonable value. First, by squaring the individual terms, or taking the square of each term, you can effectively determine the absolute value of any given data series. Then, to standardize the entire series, you would calculate the z-score for each data point. This crucial process allows you to express every individual variable in terms of its standard deviation units from the mean. So, what I'm able to do is first compute the z-score for the observed return, and then, from that, I can proceed to construct a completely new and distinct data series. So the next group of methods we're going to consider falls under the umbrella of time series transforms. Within this particular family of techniques, one powerful operation we can employ is known as differencing, and this specific process will prove highly beneficial in our efforts to significantly mitigate the persistent issue of non-stationarity. This means that if we observe a trend which indicates the series is not stationary because its value or its mean is consistently changing, then applying the first difference can significantly help to mitigate this issue or potentially even resolve it completely. We have the option to apply the first difference or a second difference, or indeed as many lags as might be necessary. For instance, the initial calculation known as the first difference involves subtracting the value from the preceding year from the current year's value. Alternatively, we might express this as a percentage, which is commonly referred to as a growth rate. To achieve this, once we've determined the difference, we then proceed to divide that result by the previous period's value. Well, in addition to other statistical measures, we can also quite effectively determine what's referred to as the rolling mean. This specific analytical technique essentially necessitates the process of calculating the average from a sequence of preceding data values. Consequently, for instance, we are able to precisely define our calculation window to encompass the most immediate 5 historical data points. As a practical example, we possess the complete freedom to choose the exact dimension or extent of this particular window. We will begin by computing the rolling mean for our specific size variable, which helps to smooth out any short-term fluctuations. Once this new derived data series has been successfully generated, it will then become immediately visible and accessible further down the processing pipeline. For instance, right here, we can clearly observe the computed rolling mean for the size data, and it's also quite straightforward for us to directly compare this new series against the initial raw data series to understand the differences. Now, the rolling mean is a very useful technique that will help us to effectively smooth out the inherent noise in our data. As you can clearly observe on the graph, the calculated rolling mean here is significantly smoother and exhibits considerably fewer fluctuations when compared directly to the original raw data series. This is the primary advantage. Pause. We have the capability to calculate the rolling standard deviation, which essentially means we're determining the inherent volatility of our time series variable as it evolves over a specific duration, utilizing a window of 5 or any desired number of n periods. And finally, the cumulative sum, which adds past values together. For example, I can apply that. Regarding the annual return, I can calculate that specific figure by taking all of the past financial values and simply adding them all together to get the total. After we've successfully added this new variable to our calculations, I'll be able to directly compare the initial original return against the comprehensive sum of all the individual annual returns. Now, the monthly return, it really should be somewhere around 1.5% or maybe 0.3% or something like that. Pause. Of course, there will always be some degree of fluctuation, but if we consider the average, we should probably see a value that's quite close to 1%. So when we talk about this sum, what it's essentially doing is taking all of the historical values and adding them together. Now, given the fact that on average, the market tends to provide us with a positive monthly return, this consistent positive performance will naturally generate a clear upward trend. This is primarily because we are continuously accumulating those past and very often positive monthly returns. Therefore, you can essentially think of it as a cumulative variable, building up over time.
Next, we're going to present the latest seasonal collection.
Decomposition. Now, for season decomposition, the data series must contain non-empty values throughout. So in this specific scenario, while we might consider using the annual return, we often encounter issues with missing data points. Crucially, the very purpose of season decomposition is to analyze seasonal patterns, meaning we cannot simply rely on aggregated annual figures alone. It seems we're going to have to select a completely different frequency setting this time. So what I'll do is I'll just refresh this entire page right now, and then I can carefully pick out a frequency that actually shows us clear seasonal patterns. For our purposes, I believe the best and most appropriate option would be to go with a monthly frequency.
Just allow it a moment or two to fully refresh.
And then we're going to shift our focus once again to time series. First, we'll need to select the monthly option, then we'll choose the specific period from the year 2000 up to 2024. Finally, we'll confirm our choices by clicking apply. At this very moment, it's building the working sample. Alright, so let's begin by addressing our very first variable in this analysis. I'm going to select the stock's monthly return as our primary data point. My methodology dictates that I will select every single firm included within our specified sample. Then, when applying the necessary aggregation technique, I will determine the cross-sectional average return. This process ensures that for each individual month, we generate precisely one distinct data point, which then collectively forms a comprehensive time series variable on a monthly basis. After we've finished applying the filters, we'll then need to assign it a name. Of course, you can always retain the original name for your data, but what if you then decide to create a second series, perhaps series B, and you need to use that exact same variable again? Therefore, in this specific scenario, it becomes essential that you choose a unique naming convention if your intention is to select and utilize that identical metric within your other newly created series. This is simply to ensure that we completely avoid any potential confusion or ambiguity. Let's just refer to it as series. This represents the total market return, because our analysis included all firms.
It needs a little more time.
And then we'll move on to creating an additional time series variable, one that's calculated on a monthly basis. And for this particular instance, I'll be utilizing that very same variable once more, which is our monthly return. However, I'll be selecting a distinctly different sample. I'll be focusing on a very specific subset of the overall market, so I certainly won't be leaving this particular section empty. I plan to carefully select a handful of specific industries, making absolutely sure that I have a sample that is quite distinct from the Series A, and then, following that, I'll be able to effectively apply various filters. So you're able to utilize the exact same variable, but by applying a range of different data samples, which means that ultimately the outcome will be a collection of varied numerical values. And I'm also able to give that a particular designation.
A specific portion of the entire market.
You need to go back to the previous screen. Then simply use your mouse to click somewhere in the area that is not within the boundaries of the box. If you just give it a little more time, all the relevant information will be updated. All right, so at this point, we're going to navigate back to our specific new series section. Once there, we will then proceed to create a brand new series, and following that, we'll apply the technique of seasonal decomposition to it.
Give it some
Time. Now, in this particular analysis, what we have carefully done is to fully decompose the observed time series data into its primary constituent elements. These are specifically identified as a long-term trend, cyclical seasonal variations, and the inherent random noise. So what we're examining here is fundamentally comprised of three distinct components. These components can be combined in two primary ways, either through an additive process, where we simply sum them up, or multiplicatively, which involves taking each of the three individual terms and multiplying them all together. Ultimately, the final outcome is a single comprehensive series that has been carefully broken down and analyzed into these three constituent parts. So let's take a moment to revisit the specific section concerning the process of addition. And as you can clearly observe on the screen before you, we have successfully brought these three distinct components into a unified whole. Now, should you proceed to meticulously combine these three individual segments, the resulting sum ought to perfectly restore the original complete series that we initially began with. So, in this case, the seasonal period is 12 because our data is monthly. This means we're looking for the January effect, the February effect, the March effect, and all of these we refer to as the seasonal part. So, if you have a clear trend developing over time, that specific pattern will be captured right here, and all the remaining parts, the residuals, will then be captured and shown over here. Now, the really interesting point to consider is, if you want to you have the capability to visualize and display these individual decomposed components. But in this situation, we really need to create the series first. And then we'll be able to plot out each of the three individual components. We have the three distinct parts that make up this analysis. We are able to zoom in and examine each of these components individually. Now, focusing on the other significant term, specifically the residuals part, this particular element effectively captures the entirety of the image data. But beyond that, we can also clearly discern the overall underlying trend within the information, as well as the specific seasonal variations that are evident here. Ultimately, what we are looking at right now is precisely the dedicated seasonal component. and the remaining parts of the process, as you can clearly observe within the provided image. Now, at this point, we have the option to return and select an entirely different approach or methodology. For instance, one powerful technique we could employ is called feature extraction. This process involves taking numerous individual time series datasets and then efficiently compressing all of that complex information down into a single, more manageable set of synthetic factors. So, in this particular instance, we're using principal component analysis for the time series variables. This method aims to identify the strongest common movements and then determine specific weights that will maximize the variance of the resulting combined index.
So for example, let me select all the individual components that we had previously created, the trend, the seasonal, and the residual.
Now, in this particular scenario, applying this method isn't a very judicious choice. This is primarily due to the fact that we observe a substantial degree of volatility in one specific data series when compared directly to all the other available series. Consequently, it's quite predictable that the principal component analysis, or PCA, will inherently be drawn and heavily influenced by that singular series which exhibits the most significant level of variance. However, to give you a clear demonstration of how PCA operates, I will proceed to select that particular option, and naturally we will perform the standardization process. We have a separate video that delves into the principal component analysis, specifically its underlying mathematics. Therefore, as a result, we then proceed to create these series. So, given that the residual component is the most unpredictable and volatile element within our monthly returns, it's expected that principal component analysis will naturally place a significant emphasis on this residual. We can then visualize this relationship right here, simply to observe it. So about the fundamental concept we're working with here is that we have several distinct variables, specifically time series variables. Our goal was to combine them and create a single unified variable. And as you can see, we've successfully achieved that right here. What's particularly interesting is how closely this new variable aligns with the residual component. As we continue to advance, we can also apply various families of methods, including analysis in the frequency domain or the powerful Fourier transform. In this context, we're specifically looking at the wave-like patterns that emerge within a time series dataset. Therefore, when we analyze variables within a time series, we find that they are composed of several distinct components. Specifically, we observe the underlying slow movement, which represents long-term trends, and alongside that, we can also identify the rapid fluctuation movement, indicating short-term volatility. So, for instance, if we were to select the overall market's financial return and then specifically retain only the very lowest K frequency, which essentially means we are targeting the slowest, most fundamental waves, then when you proceed to construct the resulting data series, we'll have to change the name, of course, and then following that, we'll start the process of creating the series. The first step will be to completely remove all of the previously defined variables. Following that, I intend to perform a detailed comparison against the overall market return, and then I'll need to allocate sufficient time for the frequency variable to be properly created. So you can really conceptualize this entire approach as being a combination or sum of various waves. Some of these individual waves you'll find actually change their characteristics very, very quickly. In fact, we might even consider these rapid fluctuations to be nothing more than simple background noise. However, other waves will actually move at a much slower pace, evolving gradually, much like extended long-term cycles. So with this understanding, let's now proceed to compare this particular model, or perhaps not, with. We'll go up and check if we have everything that's required. Use a variable, and then again create some series. Take more time than the annual average. It's not there yet.
Now we have it at last.
You can clearly see that we specifically chose the slower, gentler waves, and now observe just how incredibly smooth the surface is.
Of course, we can even precisely define and isolate the specific noise characteristics we're interested in. For example, we can effectively control how the system responds to the rapid movements within the data series simply by increasing this particular numerical value. Next, we'll delve into the details of the Kalman filter. This approach estimates the underlying actual value, which is hidden behind the imperfect observed data series. For instance, we monitor monthly financial returns, and these are inherently unreliable and fluctuating. Our fundamental assumption is that there's an underlying unobservable mean return regime at play. So the core concept here, to reiterate, is that if you're dealing with a highly volatile, high-frequency variable, such as something like a monthly return variable, which can fluctuate quite a bit, then by applying certain methods, we have the ability to transform this variable into a more manageable form.
How about we call it Kalman? And let's use the total market return and create a diversified investment.
For this specific analysis, our primary goal is to accurately determine the average return behavior or underlying regime of the variable in question. Consequently, any highly volatile, rapid movements, whether significant upward surges or sharp downward drops, will be disregarded. Our objective is to capture the stable, underlying, or latent mean value of that particular variable.
This way, we'll be able to display it and then compare it against the overall market.
The overall process becomes considerably smoother because we are actively removing the idiosyncratic individual movements or the inherent noise and random fluctuations by focusing our attention on the consistent mean return observed across the entire duration. And as you can clearly observe right here, what we're looking at is very highly smoothed out representation of the overall monthly market return data. And then to conclude our analysis, we also incorporate what is known as the Econometric error correction term into our model. It's simply about the errors from regressing y over x. So we should have at least two variables, y and x. And that will bring us to the next section.
The remaining term from the regression analysis.
So for example, I could demonstrate it for you now. We must now proceed to create two distinct variables derived directly from applying a specific transformation to our time series data. So what I'll do is select the total market return data series, which is specifically series A, and then I'll proceed to find the rolling or cumulative sum.
If we're going to make an informed decision, we should be using the past, let's say, 5 years of data.
And I will do the same thing for the series B round. This way I can then effectively apply the strategies. The other correction. I just need two variables. I could use the original ones, but I'd really like to demonstrate the concept.
Copy this, so commutative. And we create a new variable. Let's just give it a little more time and then we'll figure it out.
Let's go back to that other correction term we mentioned.
So for our analysis, we definitely require a y variable and at a minimum one x variable. You certainly have the option to incorporate multiple x variables or even construct a more complex multivariate model if necessary. However, as a fundamental requirement, you will always need at least one x. Therefore, the y variable in this context will specifically represent the subset. It's almost as if we're taking the entire market's performance, specifically the comprehensive return generated by all the firms within it, and then attempting to use that broad measure to explain just a smaller particular subset. This methodology, I believe, is considerably more logical and provides a much clearer perspective. Consequently, the variable x in our discussion would naturally correspond to the entire market itself.
But I'm going to use the sum and
Also, we're going to use the x variable, which represents the total market return calculated cumulatively over the past 5 months. The same approach applies to the y variable, so we're not using the raw original variable directly. Instead, we are utilizing the cumulative monthly return specifically for Series A and Series B. To clarify, it is Series A.
And then we'll be able to create series
Following that, we'll be able to plot both the y and the x coordinates.
It's essential that we formally identify that as ECT, and then we must proceed to create a series. So, the concept of the error correction term is intrinsically linked to the fundamental idea of cointegration. This principle suggests that if you possess two variables that are linearly connected, they possess the capacity to become cointegrated. It's quite clear that we're not dealing with a stationary variable here, obviously, because if we consider series A, series B, or even their transformed counterparts, the cumulative version of each consistently exhibits a noticeable upward trend. Therefore, the observed values, or perhaps the entire dataset we are currently examining, cannot accurately be classified as stationary. This conclusion is drawn from the evident and consistent pattern of their growth, showing a clear upward trend over the duration of our observation. However, despite this overall increase, the underlying linear relationships, which essentially represents the difference between these points, can still be regarded as remaining almost entirely constant, particularly within this specific segment or portion of the data. So, the difference, or more precisely the linear relationship between these elements, can be considered constant and thus inherently stationary. This fundamental concept forms the core principle behind the effective utilization of the error correction term, and that concludes our discussion for today's session. Thank you very much for watching.